Today, I'm joined by Adam Tope, a partner at DLA Piper in New York, where he focuses on fund formation, secondaries transactions. Adam has completed over 250 secondaries transactions and represented more than 500 institutional investors, including over half of the top 10 sovereign wealth funds. He works across a full spectrum of fund types: PE, venture, real estate, infrastructure, hedge funds, you name it. What I find particularly interesting is that Adam was an entrepreneur before he became a lawyer, so he brings a unique perspective to working with emerging managers. Adam, super excited about this show. Thank you for joining us.
Thanks. Thanks for having me.
Awesome. Well, why don't we get right into it? You have expertise in the secondaries. Why don't we talk a little bit about that? So, the secondaries markets have exploded in the last few years. For listeners who aren't as familiar, can you tell us what exactly is a secondaries transaction and why do they happen?
Yeah, sure. I think some people, when they say secondaries, they're thinking about trading interest in a fund they're invested into. So if you were invested into, you sell that to someone else, that is a secondary transaction. So that's like the classic example. I think you've seen in like the news or different writings about GP led continuation funds. That's sort of the other flavor of secondaries, and what that is, where a fund manager is taking a company or asset of the fund and selling that to another fund that they own and bringing in new capital to redeem investors. So they're both are very different transactions. The first is pretty simple, a way to get liquidity for LPs in a fund. The second is very much like an M&A transaction. But when people say secondaries, they're usually talking about one of those two things.
And so, which is the one, I guess, over the last few years, as valuations have fluctuated drastically, what are some of the trends of which is occurring more and which is occurring less, like the GP versus LP led?
Yeah, it's a little hard to say. Honestly, they've both been growing so fast. I think like GP leds are like sexier to talk about. So like that's what the Wall Street Journal and everyone's reporting about. LP trades, the volume's just multiples of what it was. So it's really hard to say. I think if you look at some of the data from some of the brokers, it's still fairly evenly split. Like there's just a lot of volume of LP trades and a lot of volume of GP leds. I think it really depends, but both have been growing extremely well.
From an operational perspective of executing an LP, trading of a secondaries, trading a position, and a GP led secondaries position, which is more operationally complex, which includes more sort of herding of more parties.
Yeah, GP led's far more complex. An LP trade, honestly, there's a buyer, a seller, and then the general partner in the fund. Those are like the three people involved. I'd say those transactions are relatively commoditized at this point. Like there's a process everyone follows. It doesn't really change that much, whether you do it in the US or UK or France. They all kind of look the same. Those are fairly easy to do, and most managers know how to do those quickly. A GP led's still very much a bespoke transaction. You have to have you have an intermediary like a broker, you have potentially an insurance provider like an insurer, an insurance broker, you have a fairness opinion provider, you have lawyers for the fund, you have lawyers for the investors coming into the continuation fund, you have a bunch of conflicts of interest. So you have to talk to your LPs, your advisory committee of your LP of your fund. There's just so many different parties in those transactions. They're far more complex. They're expensive because of that. There's just like a lot of stuff going on. Uh, and really, at the end of the day, like the continuation funds, raising a new fund. So there's securities law aspects and tax and all that stuff. So it's very, very complicated.
Yeah, you just named a lot of stuff. I'm curious if you could give more details or context into how they play a part. For example, you mentioned insurance was definitely not on my mind. What's like the part, like what are the types of like insurance that comes into play when you're setting one of these up?
Yeah, so a lot of continuation funds, the asset you're taking from the fund and selling to the new fund, that's often like an end of life asset, right? So it's like the fund is old, it's like 10 years old at that point. There's some assets you want to sort of give liquidity on them. Maybe those assets need more time, they need more money, something like that. So you have an old fund that wants to sell this asset. So what that means is that, in a typical like M&A transaction, there's representations and warranties and things like that about the company that you're selling to the new fund, about your title, about the cap structure, like all sorts of things like that. And in a typical, M&A transaction, there's either an indemnity, so the sellers indemnify the buyers for breaches, or you do rep and warranty insurance. So in the continuation fund context, if you indemnify people, that's your LPs of your old fund, indemnifying them. So that means you're going to have to go chase limited partners in a fund that is old and ask for money back to pay, the new fund. And it's just like you're going to really 400 people for, their share. So in a lot of these transactions where the manager's focused on sort of having a clean break, they'll get an insurance policy instead. So then the continuation fund makes a claim against the insurance policy and gets paid, and you don't have to chase LPs. It obviously costs money. It's not free, but it's more efficient sometimes.
Got it. That makes sense. So there's definitely a lot of moving parts in these secondaries transactions. I'm curious if you could give, and they don't have to be specifics about something that you've worked on, but even broader strokes of what's an example of when things go well, like what are typically, a cookie cutter, easy GP led transaction where all the parties are aligned. What's an example of an experienced manager, and what are the key parts to making sure a transaction goes well? And then I guess more interestingly, I'm curious when things go sideways, what are examples of things where you've said, hey, GP brought this up and because of various reasons, the deal didn't launch or it took, a lot more time. What looks good and what makes it hard?
Yeah, I mean, look, the simplest deals are like venture deals, honestly, like a venture continuation fund or some sort of PE continuation fund where it's sort of like the fund that's selling is not controlling that company. And the reason those are simpler is quite honestly, they don't control the company. They can't make a lot of reps about the company other than like we own the shares and we're not aware of the company, defrauding people and, like basic stuff. So like those are pretty easy transactions. Like a complicated one would be you control, an energy company that has regulatory issues and there's environmental issues and you control the board so you know what's going on. So here's 50 reps about the company's operations that, the buyer wants and things like that. That's where they start getting complicated, to be honest.
That makes sense. So it's really like the complexity of the asset itself and the
Yeah.
ownership structure and liability is what plays a part of it. Interesting. Great.
Yeah,
And
look on
then,
a vet
yeah,
secondary, like we could get it done in like 2 weeks. Like it's a week. It's very fast for a
okay. And those other
complex
ones could take months or quarters, I imagine.
months. Yeah, yeah, yeah.
Yeah. Okay. And then where do you see the secondaries market going in the next few years? It seems like it's not going to slow down. I know there's a lot of funds specifically launching to grow on, buying out secondaries positions. I would imagine you're seeing a trend uptick. Is there anything unique that you think is going to come over the next couple of years?
I think you're seeing credit secondaries, so like, loans and things like that, trading, like that's been increasing. I'd say over the past couple of years. I think real estate secondaries is still really pretty small. I think I expect that to sort of grow as people think about that. Infrastructure has grown pretty well. I think private equity and venture is pretty fairly mature, like people know how to do it. But I do think credit and real estate will grow.
Well, let's shift a little bit away just from secondaries and more broadly to structuring of funds and new fund launches. So you've worked with spin outs from large firms, groups, I'm sure, spinning out from, Apollos or Carlyle's. And what are some of the unique challenges that you see those managers running into for the first time? Oftentimes, what we see is they're folks who are familiar with doing deals, but maybe they're not as in the weeds of operations. And so sometimes it's the first time launching a fund. They don't know what they don't know. So I'm a little bit leading the question there, but what are some of the things that you focus on when advising a new group who's leading a larger shop to get set up for the first time?
Yeah, I think look, there's really two issues, right? So first, you want to raise a fund, so you need to find money. And a lot of these groups, we work with a lot of, maybe more junior people than more senior people at these funds that, want to do their own thing. And usually my first question is like, where are you gonna get your money, or do you have your first dollar at least? And I find that some of the junior guys just don't interact with the LPs in their funds all that much. So it's like very hard for them to sort of call that endowment that gave that fund money and talk to them about giving money. So I think, successful, sort of the most successful are where they have like an anchor person that they met at, the annual meeting, or did a co-invest in a deal and they got to know that investor. Those are obviously the ideal situations. I think the next best thing is we see people, hiring placement agents that specialize in first time funds and things like that. And, so long as, there's some sort of good deals, they can sort of spin that messaging. And I think that brings me to sort of like the second issue is like track record is sort of like the second biggest issue. So from like a technical standpoint, almost no one leaving a firm has a usable track record for like SEC purposes. And that basically the SEC says if you did the deal and exited the deal and you were like the sole decision maker, that's your track record. But like you and I both know that's not how funds work. There's an investment committee and there's people involved. And if you're a junior mid-level person, there's probably some MD or senior MD above you that ultimately blessed it. And so like you probably don't have a usable track record. And frankly, your agreement with your manager in your carry plan or employment, it probably says you can't use it also. So it's sort of figuring out how do you tell the story of the deals this person did without like really showing returns, because you can't. So that's sort of like the other issue you have to deal with.
Okay, great. You just mentioned two great points I would love to ask about. Well, let's just go back on the one that you just mentioned. So, like track record attribution, I guess I hadn't realized that. So, what you're saying is that some of these employment contracts for working at a larger firm, they are written in the depth of like technicality that you can't really attribute deals to yourself unless you are a certain level or can point to a certain track record. I didn't realize it became
The
black and
SEC
white to some
actually.
extent with SE.
Yeah, so the SEC says that, like, if you're marketing like a fund, like an offering memorandum for your fund, like you can't put your track record in unless it's like a usable track record, and almost no one has a usable track record. And then, like, if you look at your like covenants and confidentiality and the trade secret stuff you signed when you worked at your fund, I guarantee that says like you can't use the track record or any data related to any deal you've ever done that's not public, right? So like at the end of the day, you're like, okay, like what do I have? And so like what we spend a lot of time is like the people leaving funds, like hopefully they've had a deal they did and it went public or got acquired and there's, stuff out there, right? Like the Wall Street Journal wrote an article and then somebody put out there like this is what the returns were like and things like that. And we sort of like build the story using like public info. Sometimes we make case studies and it's sort of you never say the company name and it's more unbiased, if you will. But there's things like that. That's just the game you have to play, fortunately.
Got it. That's fascinating. I didn't realize in a literal sense the sort of hurdle there is for folks spinning out like that, but it makes a ton of sense. The other point you made on that I thought was interesting is another sort of literal fundraising conversation is that the onus, when someone's spinning out a new fund, you have to have money to back you. And those relationships do start from knowing your fund's LPs. Everyone, hopefully you have friends and family that might be able to fund your fund. That's great. But otherwise, one of the ways in is building a relationship with LPs in a fund that you're working on. And I guess you're right. Yeah, in a literal sense, those conversations happen at like annual meetings. They happen at, on calls. Is that commonly how you see people building relationships with an
Yeah,
LP
it
and then they
is.
sort of sidebar? Is there a gray area of sort of walking the line of like having a conversation about your new fund launch with them?
Yeah, so I mean, look, you need to look if you're like a deal person in a fund, you need to see what you agreed to. So like a lot of funds put in like you can't solicit existing LPs and things like that for a period of time after you leave the firm, right? So like that explicitly would limit you from doing that. But what we spend a lot of time doing is like reviewing those words and figuring out like how do I get around that? And maybe you're not asking that endowment for money today, but maybe you're talking to the person that runs that endowment endowment about what you want to do, and they liked the deal you did for them, and connects you to their friend, other endowments, things like that, that could potentially work. I think what I tell like junior people that want to leave is really do try to just interact with the LPs if you ever get the chance. So annual meeting, or if you're going to visit an LP with like an MD, and you meet some deal people at the endowment, like there's nothing stopping you from grabbing a drink with them or a coffee and like getting to know them. I think the most successful first time funds I've seen, those junior people and more senior people have built like relationships, gone golfing with the LPs, things like that, just like socially, and that has paid huge dividends. I find people with first time funds that just like have never talked to an LP, it's just incredibly challenging.
That's great advice. That's awesome. Let's change a little bit to, let's say we've got someone who's got a good track record. They did a great job networking with investors, and now you are going to start moving forward on fund terms for a new debut fund for them. Talk about some of the terms. Well, actually, let me phrase it this way. When we help new managers launch, and I say this a lot, is we try to encourage them to be simple. Simple generally helps just operationally and efficiently to be on top of everything. And on the expense side, simplicity generally is going to help you out, keep expenses lower. So in the realm of sort of that context, what are some of the other things around terms or even side letter negotiation, the types of things that you advise emerging managers to, lean into or to avoid?
Yeah. So, I mean, look, I think you got to keep it normal looking, right? Like, you got to raise money. The more weird stuff you have in there, or the stuff you concoct that you want to do, like, that takes time. And a lot of managers or money will just say, no, like, we don't do that. That's not normal. So, like, I get a lot of people that come up with creative, I want half closed end fund, but also half hedge fund. And like, you give money to both at the same time. And has like I get these crazy ideas like that's hard to raise money, right? Like, if you keep it as basic and simple as possible, you can raise money pretty easily, because at the end of the day, your investors are looking at the checklist or some checklist, and they're counting how many things are off their ideal. And if you have some crazy structure, it's just going to be hard to do. And then I sort of advise people like, look, like what is it that you actually care about? Like, you like, what, like, everybody always has like one or two things they care about, and I'm not talking management fee and waterfall, like that's economics, money in your pocket, that obviously is important, but there's other stuff like, I'm working on a fund now, and this person like really didn't want to give a key man provision, which is pretty normal. And that's, if that person gets hit by a bus, like what happens to the fund? So like, I help sort of talk and say like, why do you really care? And like, let's talk about it. But other things are, I have people that like they must be able to use operating partners, and or they have different sorts of requirements in their mind. So like, we pick a couple things like we care about, and then we try to keep everything else like market, and that just makes the fundraise easier. And by market, like, to be clear, like at DLA, like, we have access to thousands of LPs, and we have AI and all that good stuff everyone else has, and like, we can tell you like, that is similar to similar funds or not. And that's pretty powerful and makes it easier to negotiate.
Makes a lot of sense. We'll definitely circle back on AI in a second there, but I will double click on one of the ones you mentioned there. You mentioned operating partners. What's an example of, I guess, what is standard when funds do or don't want to use operating partners, and where does it become like like a hookup or sort of like a catch that someone might raise a flag against?
So I think, I mean,
And
look, the
I
big
guess
one.
maybe firstly, if you wouldn't mind explaining, like, what is an operating partner traditionally?
Yeah, so an operating partner is sort of like, the traditional example is like a senior executive of whatever. So let's say you invest in restaurants, right? So that's like what your fund wants to do. Like, the classic operating partner is like a senior executive of some restaurant chain that's like semi-retired, but like still wants to like dabble in running businesses. So you would team up with them. You would put them into the company you're buying and to operate that business. Maybe they're the CEO, maybe they're just like on the board, some sort of like high level consulting. And basically you as a fund manager leverage that experience that you don't have, running a restaurant business for 50 years. And, you put that in your portfolio company, the portfolio company money, potentially give them some management, incentive units, things like that to incentivize them. And, if there's a good exit, that person makes a nice check. So that's the typical like operating partner model. I think, you see that the large funds have that. No one's really debating it. Like that's how they do a lot of things. I do find it sometimes challenging for like first time funds to really like kind of also do that. And the reason is a lot of people look at you and say, this is your first fund. Like, that's why I'm paying you. Like, not to go hire your buddies to go work at the portfolio company. Like, I'm hiring you to go run the companies, advise them. So there's always sort of like that sort of debate. I think at the end of the day, like most funds can win on it. I think most investors appreciate that, like the operating partner and well, so it's not a big deal, but I think, I do see some pushback sometimes.
Interesting. Thanks. That makes a lot of sense as well. From the time that someone comes to you to launch a fund, can you give sort of a rough timeline of how long a firm like DLA, your team might need to get all the docs in place and help start onboarding investors? I'm going to guess the biggest driver is, do you actually have funds? Do you have folks who are ready to subscribe to your fund? Let's play with an assumption where there's a great, handful of anchors. It's a great new spin out. They come to you. How long does it typically take your time to sort of go through a few drafts and help them get launched so that they can start collecting capital and start doing deals?
Yeah, sure. So I mean, look, like the first thing we do with new managers is make like a term sheet for the fund. Like that takes like a day or two. I'll be honest. Like we have a form. I usually give it to the person. They read it. We do a call. Like it's done in a day or two. That's sort of like the baseline of the fund documents, if you will. So then at some point, yeah, like you said, we're assuming we have people asking for fund documents and they want to give you money. So then we have to draft in the simplest way, a subscription document and a partnership agreement. I'm assuming, we've spent some time and figured out the structure. If it's a private equity or venture fund, it's very simple. If it's, real estate or credit, it gets complicated, but it's not like we're reinventing the wheel here. Like we've done these structures a million times. So we're sort of recycling stuff. So let's just say simple fund, the structure is simple. And if it's a complicated one, maybe, a couple of days to figure out the structure. So then, we have the critical mass of LPs and want to do the fund documents. I'd say the typical LPA takes about 2 weeks. I'm just, we've done it faster, we've done it slower, but assuming the fund manager is, aligned and not on vacation and like focused on it, like, we usually can get the first draft in a couple of days and then you kind of go back and forth and do some calls. And then, I'd say 2 weeks, it's done. The subscription documents take like a day. Like it's not, we have a form. There's not a lot of customization there. Once you have those two documents, like you can raise a fund. I think a lot of managers do an offering memorandum, or a PPM, that you call it sometimes. Some don't. There's no legal requirement. You don't have to do one. Honestly, most of our managers don't even do them anymore. But if you do that, that can take 2 or 3 weeks. It could take a month. There's just like a lot of marketing stuff and, the pitch and working on that pitch and making it sound good. It takes a while. Uh, other than that, forming the fund is like the actual birth of the entities is takes, frankly, it's like an hour. It's like very simple. You have to get tax IDs that can take, get that the same day. Then opening a bank account because you want your LPs to give you money, that frankly can take 2, 3 weeks. I'll be honest. And then other than that, there's sort of this like last regulatory piece. And really there's sort of two key regulatory issues. So one, most funds file a Form D, which is a public filing saying you sold private securities to investors. We typically like to get that sort of prepared ahead of time. So that can take about 2 weeks because the government's involved and they help you get into the system and it's slow. And then secondly, there's always just the Advisors Act piece. Does this fund manager need to be registered as an advisor or not? If you need to be registered, generally what that means is you're closing on $150 million of subscriptions or more at your first closing. You need to be registered before you close. And that can take 90 to 120 days because you have to prepare the filings. That could take a month. Then you have to wait. The SEC can take up to 90 days to approve it. So that's really the key thing. So like what we do to deal with that is there's sort of workarounds, if you will, to kind of accelerate that. But that if you really do need to register and there's no other option, like that's going to hold you back from really closing your fund for about a quarter.
When you're working with a manager like this, you're yeah, I'm going to assume you're like the lead partner. I'm curious about the team structure. Like, who else does a client typically face off with, or who else is helping them through this process? Like, what does your sort of team verticals look like when someone comes to you?
Yeah, I think it depends on the firm you engage. Like some firms have lots of associates on them. I think, look, when you hire us, it's like pretty simple. There's myself leading it. There's a tax partner leading your tax structuring. Tax is incredibly important in all this. And then other than that, I usually have like an associate or two, depending on how much money we're raising. They're sort of, doing the grunt work, forming the entities, drafting side letters, things like that. But, let's say, it's three to five people, maybe even sort of the billion, 2 billion, $3 billion funds we raised, those teams, at least at our firm, are five people maybe. It's pretty streamlined.
Cool. Well, with the ability to run streamlined teams, I'll bring in the technology conversation. Curious where you think AI and technology is showing value or you think will show value, and then where it might be kind of hype so far. Things move incredibly, incredibly fast, it seems like at this point.
Yeah, so I think there's really sort of a couple technology solutions that didn't exist maybe 5 years ago. So look, like subscription documents are now digitized and most people fill those out electronically. And like 5 years ago it was manual. Now it's very little manual in my experience. Like people log in, they click some buttons, and the subscription is submitted. That industry is pretty well run at this point. So people fill those out. If they had invested in a prior fund, you can kind of duplicate the information. Makes it very simple to get money in the door. Those products work very well. I think some of them help the lawyers check the documents and make sure the secure law is dealt with. Some of those products, anti-money green checks, things like that. But like generally speaking, the products work well. So I think sort of there's a lot of companies doing that. A lot of admins do that. It depends, but I would say sort of broadly speaking, there's really like three products that are pretty big. So there's Funded, which is like a spin out of Kirkland and Ellis, which is a large law firm. So like Kirkland clients use that. So like that's a pretty big one still. Um, there's Anduin and Pass Through, which are third party products, which we use both. And then some law firms sort of have their own as well. But generally speaking, I'd say, Funded, Pass Through, and Anduin are sort of like the key three players in that space. But there's a ton of people. I think no, I was just gonna say like sort of the other sort of pieces we're seeing. So we've been seeing some side letter management products. So side letters, just to kind of explain what that is so there's a fund agreement. That's the agreement all the partners sign on to, but you can modify that with a side agreement. That those typically include like special reporting rights and things like that. Maybe there's a fee break, so the fee discounts will be in a side letter, things like that. But what happens is if you're raising a fund and it has 50, 100 investors and there's 50 side letters, it starts getting very cumbersome. So there are a handful of products out there that help manage that process. So those, they're not perfect, but they've been working pretty well, the ones we've been using. Sort of other than that, I mean, there are companies and law firms out there that digitize the LPAs and different stuff like that. I'll be honest, like they're not great. I think a lot of them will say we're not law firms, we don't provide legal advice, and you sort of are stuck with their form and you can't change it. Like unless you're the most generic fund ever, it just doesn't work if you want to customize it at all. So I don't usually go that route. And I don't think honestly the cost savings are that huge. if you're raising like a real fund. If you're raising $5 million, like sure, it's cheaper. But let's just assume you're raising like a nice fund, 150, 250, $300 million. Like you can't use that product. If you take that to an endowment, they're going to be like, what is this?
Yeah. Yeah, that makes sense. The endowments are going to want some institutional sort of comfort or check mark a little bit there. Well, let's shift a little bit. I mentioned in the intro that you have an entrepreneurial background. Before you went to law school, you were an entrepreneur. Can you tell us a little bit about that company, a little bit about what you learned, and if you think it impacts how you sort of support your clients today?
Yeah, I mean, I did a bunch of things in college. Ran like a tech company that ran like web servers and like data center kind of things before people knew what that was. And we programmed some software products. I think really like that's, I guess relevant if you're raising a data center fund or something, but it's not relevant to a private equity guy. But I think, look, it was a very good experience because like I started a business from scratch. Like I hired people, opened bank accounts, figured out how to form, an LLC, things like that, right? So I think I think it helps with the experience of meeting new managers and like walking them through it. I think a lot of lawyers are not as good at that because they've just never really experienced it. They know how to make a fund partnership agreement, but they don't really know how do you get healthcare to offer your employees of your management company. Like I've done that sort of stuff.
Awesome. Well, what else would you like folks to know about the fund formation practice?
Yeah, look, I'd say the single most misunderstood point that every single emerging manager doesn't understand is expenses. So, like, what do I mean by that? I mean, who bears the costs of running your fund business and the fund and finding deals? And every single person I meet who's never run a fund thinks that the management fee, that fee you get to manage the capital of your fund, pays for everything. And that is not correct at all.
Yeah,
So
please talk about this. I should have had this on my list to proactively ask you. So please share what folks
yeah,
should know.
so like let's take a step back. So funds, the typical fund is 2 and 20. So what does that mean? That means so if you raise $100 of commitments, you get paid a 2% management fee, so $2 a year. You get a check $2 a year. And then as you exit a deal, you get 20% of the profits. So like, that's the basic economics. So the management fee is used to rent the office space and pay the salaries of your analyst and your CFO and your secretary and whatever that is. Buy some computers, pay sort of the overhead of the business. That is what the management fee comes into the business and pays for. Basically it. So I usually get the question, well, I'm only getting, $500,000 in management fee revenue. How am I going to possibly search for deals and pay the admin and pay you the legal fees and all that stuff? I think the most commonly misunderstood thing is that almost all fund agreements have a expense section that is outside of the management fee and that the investors actually pay expenses to run the fund, like as simple as that. So every 99 out of 100 first time managers I talk to just don't get that. Now, I'm not saying that's like a party and like you can just like go spend the money on, champagne and fancy hotel rooms and travel the world private jet. Like that's like you're still a fiduciary, right? Like you can't go crazy, but most investors assume that you're going to spend a significant portion of your fund on expenses on top of the management fee. Like that's just how it is. And I don't think most first time managers don't appreciate that. And when I tell them, they're just like shocked. But like that's how the fund they worked at ran, right? Like the management fee paid their salary and everything else was charged to the fund.
Yeah, they never knew anything to the side. Why would
Yeah.
they have been involved with who's paying the fees for the admin, where the legal fees are being paid out of? They're none the wiser.
Yeah. Yeah. So like that's the key thing people don't get in all this.
That's a great example. Can I ask you? So I know to a certain extent you can overdo it, right? Like you were alluding to, what are the broad sort of guidelines you think? Because you can get slapped with, the SEC can come and audit on expenses there, and you can get slapped with pretty hefty fines if you sort of overdo it, right? What are the broad like guide rails? Management company runs your business, fund expenses generally cover services needed to operate the fund entity specifically, right?
Yeah, so like five and more than 5 years ago, 10 years ago, the fund documents just said anything other than management company overhead is a fund expense. Like it was literally a sentence. Okay. Like if you look at
Oh,
like a
interesting.
20-year-old fund document, it was like a little sentence. And so the SEC started going after the fund managers and saying, well, how do you know that the investor thought you were going to charge that dinner, those Super Bowl tickets you took, that management,
Yeah,
that
I
that
think
that
of
management
like
company.
travel and like
Yeah.
deal sourcing and even travel related to continuing on fundraising for the fund when investors are already in. That's some of the stuff that comes to mind for me is like that probably blinks red.
Yeah, so basically the SEC started enforcing against people, and they're saying, how was that sentence adequate to tell your investors that they would be paying for whatever? So like about 10 years ago at this point, people started saying, well, how do I solve this problem? And the SEC says, well, you just tell your investors what you're going to spend the money on and charge them for. So like when I was like a fifth year associate, we sat around a conference room with like a hat, and like we just put junk in a hat and just started pulling words out and be like, ooh, private jets, ooh, admin fees. So then about, 9 years ago, the expense provisions started getting bigger and bigger and bigger and bigger and bigger and bigger. And now a 2-page long list of expenses that you might charge your LPs for is completely normal.
Is
And that's
customary. Wow.
because the SEC will audit you and say, "Show me where on the list you said you charge that to your fund investors." And as long as you can point to it, they can't do anything about it. But if you can't point to it, they say, "Should you have done that?" So that's why every year every law firm, like we're not conspiring, but like, every law firm starts adding their own stuff. So like you see attending conferences that might lead to new investors, sending swag to your LPs at the LP annual meeting because people were
Wow. So it
charging
gets really
for our
granular
little
now.
vest, like it just like it gets super granular. So it's crazy. So like we have a pretty standard 2-page one we think covers like 99% of what you'd ever do. Almost all fund agreements say if you're unsure, you can always ask the LPAC, and who's the independent LPs that advise you, and if they bless it, it's kosher, and like that's like what you do. So like it's anything at this point that you put in there.
Well, thanks for explaining that. That's really good context to know. Advice. So let's think maybe a little bit more specific for you, maybe for folks who are working at a law firm, maybe even at law school, thinking about getting into the investment funds ecosystem and be on the track to be a funds partner like yourself. What's some advice you might have for them as they're earlier in their career?
Yeah, I mean, look, I never took a funds class in law school or even frankly knew what a fund was. I think when I was in undergrad and law school, funds was not really like a thing. Like it was not common knowledge. Like there were
Wasn't a
hedge funds a
special
little
to
bit, but it wasn't a specialty. I think now it's very clearly a specialty. So I think the most successful associates I work with took a course on the Advisors Act and like understand the basics. Maybe they took a corporations course so they understand how LLCs and partnerships work, things like that. Securities law, I highly recommend, just so you understand how securities offerings occur. Those will be very useful as a funds associate. I think still at the end of the day, it's the training of the law firm you work at and the partners you work with. And, we at least at DLA spend a lot of time with training and going through, the different aspects of fund formation. And then obviously hands on is, you just gotta type and draft some contracts and figure it out. But, I'd say other associates that I meet that I think are successful just like read a lot. I had a law school professor who was like, just read the Wall Street Journal every day for 10 minutes. Like, so go get a subscription. It's like what was it, $2 a month or something? Like, just go get the subscription, log in every morning when you're in your coffee or doing whatever smoking a cigarette, whatever it is, and just like read the Wall Street Journal for 10 minutes and just like read about what funds are doing and what private capital is doing, and just like understand the words. I think that's key these days.
Awesome. Well, that's great advice. This is awesome. You're great. Thanks a ton for taking the time to come on here. I'll have to have you on for another follow-up conversation, and we'll get deep in the weeds on another topic. But thanks a ton for joining here.
Yeah, thank you for inviting me.